Okay, Sophie, today is powerful. Just look at this image. The title says Trading Lessons, but this is not just about lessons. This is about pain, patterns, and precision.
Exactly, Lucas. When I look at this chart, I don't just see candles. I see emotions. I see hesitation. I see fear. And I see traders repeating the same mistakes again and again.
Let's break it down slowly. At the top of the image, we see multiple sell signals placed near local tops and buy signals placed near bottoms. On paper, it looks easy.
Yes, but in reality, when you are inside the trade, it never feels easy.
Never.
So the first lesson here is simple but powerful. The market always looks clear after the move, but during the move, it feels uncertain.
That's a huge psychological trap. Beginners believe professionals know what will happen, but professionals don't know. They manage probabilities.
Let's analyze the first major structure on the left. We see an uptrend. Higher highs, higher lows, then price touches the upper band and a sell appears.
So, question, why sell there?
Because price extended too far from the moving average. We have volatility expansion, we have overextension, and we see exhaustion candles forming.
Exactly. Lesson number 2. Never chase extended price. When price moves too far too fast, smart money prepares to take profit.
And what do beginners do?
They buy at the top.
Because they feel FOMO.
Fear of missing out destroys accounts. Now look at the big drop in the middle.
This is where panic begins. When price collapses, most traders sell at the bottom.
Yes, and then look, we see a buy signal exactly near the lowest point.
This is lesson number 3. Fear creates opportunity.
When everyone is afraid, price is often near a reversal zone.
But you need confirmation. You don't blindly buy. You wait for structure shift.
Exactly. And I see here that price formed a base, volatility contraction, then expansion upward.
This is accumulation.
Smart money accumulation. Now let's talk about the bands.
We see something similar to Bollinger Bands or dynamic moving averages.
Yes, and notice something very important. Price respects the bands as dynamic support and resistance.
This is lesson number 4. Indicators don't predict, they frame context.
Beautifully said. Now let's zoom mentally into the right side of the image. We see another uptrend, but something changes.
Momentum weakens.
Yes, the highs are still forming, but candles become smaller. Wicks appear. That's loss of strength.
And sell signals appear again near the upper band.
Lesson number 5. Distribution happens before collapse.
Big players sell into strength. Retail buys into excitement.
And then what happens? The drop.
And retail is trapped.
Let's talk risk management.
Because even if you understand all of this, without risk management, you lose.
Yes, the image shows perfect entries, but in reality, we must assume we can be wrong. So what's the rule?
Never risk more than 1 to 2% per trade.
Exactly. And always define stop loss before entry.
Not after.
Never after. Now let's talk about emotional cycles.
The market repeats psychological cycles: optimism, excitement, euphoria, anxiety, denial, fear, panic, capitulation, hope, recovery.
And this chart shows at least 2 full emotional cycles.
Which means one thing.
Patterns repeat because human psychology doesn't change. Let's go deeper into structure.
In the left section, we had clear trending behavior. In the middle, we had sharp reversal. On the right, we have lower highs forming.
So, trend shift.
Exactly.
Lesson number 6. Respect market structure over indicators.
Indicators follow price. Structure leads analysis.
Now I want to talk about the smaller chart at the bottom of the image.
Yes, that lower time frame.
This is another key lesson: multi-time frame analysis.
A trade that looks good on 5 minutes may be terrible on 1 hour.
Always align your time frame with your strategy.
Scalper? Use small time frames, but check higher context.
Swing trader? Focus on structure. Now let's talk about discipline.
Many traders know all this theory.
Yes, but knowledge is not execution.
So the real question is, can you wait?
Patience is edge.
Most trades you don't take are the trades that save your account.
That's deep. Now let's talk about false signals.
Even here, not every sell is perfect. Not every buy is perfect.
So how do we filter?
Confluence.
Exactly. Trend direction, volume, structure, support and resistance, momentum shift.
When 3 or 4 elements align, probability increases.
Let's talk about the biggest mistake beginners make when seeing this image.
They believe trading is about finding perfect signals.
But trading is about managing imperfect situations.
Powerful.
Now, emotions again.
When price drops sharply, adrenaline rises.
And adrenaline kills logic.
Professional traders reduce emotion through systemization.
Rules eliminate chaos.
Now, final deep lesson.
The market does not reward intelligence, it rewards consistency.
You can be smart and lose. You can be average and win, if disciplined.
This chart is not about signals, it's about behavior.
Behavior repeated with discipline creates edge.
And I want to end with something important.
Go ahead.
Every chart is a mirror. It reflects your personality. Are you impulsive? Are you patient? Are you fearful? Are you greedy?
Trading exposes character.
And that's why trading is not just financial, it's psychological growth. All right, Sophie, let's slow everything down. When someone sees this image quickly, they think it's simple. Buy low, sell high, follow the signals. Easy money.
And that illusion is exactly why most traders lose.
Exactly. Because this chart only looks clean after the fact. But when you're inside the candles, it's chaos, it's noise, it's uncertainty.
Let's go candle by candle in our minds. On the left side, price is trending upward. We have expansion. Momentum is strong. Retail traders feel confident.
Yes, they feel invincible. When price is rising, everyone becomes a genius.
And that's where overconfidence enters.
Lesson number 1 in depth. The market punishes emotional extremes. When traders feel too confident, they increase position size.
They stop respecting risk.
Exactly. They remove stop losses. They average up emotionally instead of strategically.
Now, look at that first sell signal near the top. Why is it there?
Because price is stretched far above its dynamic average, the volatility bands widen. That's not strength, that's climax.
Most beginners confuse expansion with continuation.
But expansion often precedes correction.
Let's talk about liquidity.
Yes, at the top, above previous highs, stop losses accumulate. Short sellers place stops there, breakout buyers enter there.
Smart money pushes price slightly above the high to trigger stops.
That's called a liquidity grab.
Then, after liquidity is collected, price reverses.
And that reversal feels violent.
Now, let's move to the big drop in the center.
This is the emotional breakdown zone.
Yes, this is where traders say, why didn't I sell earlier?
Regret enters the mind.
And regret creates bad decisions.
Exactly. Traders sell at the bottom not because of analysis, but because of emotional pain.
Let's explain why the buy signal appears near the lowest point.
Because volatility contracts. We see long wicks. Selling pressure weakens. Volume exhaustion appears.
That's capitulation.
And after capitulation comes relief.
Lesson number 2 expanded. The best entries feel uncomfortable.
When you buy at the bottom, you don't feel confident. You feel uncertain.
Confidence usually appears near the top, which is dangerous.
Exactly. Now, let's discuss structure shift.
After the crash, price stops making lower lows.
That's critical.
Then we see a higher low forming.
That's the first signal of potential reversal.
Structure change always precedes trend change.
Indicators follow structure, not the opposite.
Let's go deeper into the psychology of holding.
Yes, many traders enter correctly, but exit too early.
Because they fear losing unrealized profit.
So they take small gains, then watch price move 3x further.
And frustration builds.
Then they re-enter late.
And get trapped.
This chart shows multiple waves. Each wave represents opportunity, but only if patience exists.
Now let's analyze the right side uptrend.
Here, price climbs again, but something subtle changes.
The highs are forming, but the candles are weaker.
Momentum divergence.
Yes, possibly RSI divergence in real context.
Which means buyers are pushing price higher, but with less strength.
That's distribution.
Smart money selling into strength again.
Let's talk about moving averages.
The dynamic lines act as mean reversion tools.
Price oscillates around its average.
And the further price moves away from equilibrium, the stronger the pullback probability.
That's physics inside markets.
Markets are not random chaos. They are controlled, imbalanced systems.
Beautifully said. Now let's go deeper into risk management.
Without risk management, even perfect analysis fails.
What is professional risk control?
Position sizing first.
Explain that.
If your account is $10,000 and you risk 1%, you risk $100 per trade. That's it. Not $500, not $1,000.
Because consistency beats aggression.
Exactly. The goal is survival first.
Survival allows probability to play out.
If you risk too much, one mistake destroys you emotionally and financially.
Now let's talk about overtrading.
Huge problem.
When traders see multiple signals, they want to take all of them.
But the best traders are selective.
High-quality setups only.
Confluence is key.
Let's define confluence.
Structure alignment, trend direction, liquidity zone, momentum shift, volume confirmation. When 3 to 4 align, probability increases.
But still not certainty.
There is never certainty.
Only probability.
Now, let's discuss emotional cycles deeper.
After winning streaks, traders increase risk.
After losing streaks, traders revenge trade.
Both are destructive.
Professional mindset, neutral reaction to outcomes.
Trading is not about being right, it's about executing rules.
You can follow rules and lose, but long-term, rules win.
Now look at the lower timeframe chart in the image.
Yes, smaller oscillations.
This teaches multi-timeframe alignment.
If higher time frame is bullish, lower time frame pullbacks are buying opportunities.
But if higher timeframe shifts bearish, lower timeframe breakouts fail.
Context controls meaning.
Now let's talk about stop hunts.
Yes, above previous highs and below previous lows.
That's where liquidity rests.
Smart money needs liquidity to enter large positions.
So they push price to where stops are clustered.
Then reverse.
So retail calls it manipulation.
Professionals call it liquidity engineering.
That's powerful. Now deeper psychology.
Most traders are not losing because of strategy.
They lose because of lack of emotional discipline.
They move stops.
They double position after loss.
They ignore structure.
They trade boredom.
Trading boredom is dangerous.
No setup, no trade.
Patience creates edge. Now, let's go deeper into expectancy.
Explain expectancy.
If you win 50% of trades with 2-to-1 reward-to-risk ratio, you're profitable.
Even if half your trades fail.
Exactly.
Beginners aim for 90% win rate.
Professionals aim for positive expectancy.
Huge difference. Now let's talk about journaling.
Essential.
Why?
Because memory lies.
Emotion distorts past perception.
If you don't record trades, you repeat mistakes.
And this chart represents repeated mistakes many traders make.
Buying euphoria, selling panic, ignoring structure, risking too much.
Let's talk about discipline as a skill.
Discipline is not personality, it is trained behavior.
You build it through rules.
Rules remove emotional negotiation.
When rules are clear, decisions are mechanical.
And mechanical execution reduces stress.
Now, final deep reflection.
Trading reveals your weaknesses.
Impatience,
Greed,
fear.
ego.
Ego is huge.
Many traders don't cut losses because they want to be right.
But the market doesn't care about your pride.
The market rewards humility
Humility means accepting small losses.
and letting winners run.
This entire image is a lesson in humility
And structure.
and psychology
And patience.
and risk control.
And emotional neutrality.
If someone understands everything we just explained and truly applies it, they move from gambling to professional trading.
And that transition is everything.
Because trading is not about signals.
It's about behavior under uncertainty.
And that is the real trading lesson.